How are all of these people not paying taxes? You have probably heard the rich do not pay taxes, or they are cheating the system, and so on. But what if I told you that you have these same exact opportunities to avoid paying taxes? And no, this is not illegal. As a taxpayer, the IRS says you have the right to reduce, avoid, and minimize your taxes by legitimate means. But the problem is really that 90% of people do not know these means. So they end up paying more taxes and have less wealth, while others pay less taxes and enjoy more wealth. So today I want to help you fix this by showing you the top 3 levers you can pull on and adjust to legally avoid paying taxes, just like the top 1%. Once you master these 3 levers, you will be able to control, literally control, the amount of taxes you pay. So let's jump right into it. Lever number 1, using tax advantage accounts. This is the easiest and most traditional way to avoid paying taxes. Because the government wants to help people save for things like retirement, college, medical emergencies, and so on, they give out tax breaks for using specific accounts for these purposes. You can use these accounts to help you avoid paying taxes today or in the future. So let's address how you can do both. So if you want to avoid paying taxes today, like this year, you can use tax deferred accounts like a traditional IRA, which is simply an individual retirement account, or a traditional 401k, which is a retirement account set up through an employer or through your own business. You can also use an HSA, or health savings account. This is just a savings account for health related expenses. Or you could also use donor advised funds, which is basically a savings account for your charitable giving. Now, every dollar you put into these accounts will be deducted from the income reported on your tax return, which means you will pay less taxes in the year you make these contributions. Plus, you can use the money in these accounts to invest and build more wealth. Now, with traditional retirement plans, your tax is deferred to the future. We're pushing this off of your tax return, meaning that you will pay tax not now, but later when you start making withdrawals. Now, because of this, making contributions to traditional retirement accounts are usually most beneficial when you are already in a very high tax bracket and expect to be in a lower one when you retire. For those with low or average tax rates, it normally makes more sense to pay taxes today and eliminate 100% of your taxes in the future. So to avoid paying taxes in the future, you can instead use tax exempt accounts like a Roth IRA, a Roth 401k, or a 529 college savings plan. Now, when you make investments with these tax exempt accounts, your investment income will be tax-free to you when you start making qualified withdrawals. But if that's too confusing and you still do not know which of these accounts to use, you can use this chart as a general guide. Tax deferred accounts like traditional IRAs are usually best when your tax rate is above 30%. Either can work when you're in the 20 to 30% range, and a tax exempt account like a Roth is best when you're below the 20% tax rate. Now, how much money you can put into these accounts will vary based on many factors like your age, your income, your filing status, and the type of plans you will actually use. There are several creative ways to get tens of thousands of dollars into these accounts every single year. So be sure to talk to your CPA about this, or at the very least, subscribe to our channel to learn more. All right, let's move on to lever number 2, maximizing your tax write-offs. So most people pay taxes before they get paid and use what is left to pay for all of their expenses. But there is a way to flip this actually. You can get paid first, write off your expenses second, and only pay tax on the leftover income. To do this, all you have to do is earn income outside of a traditional full-time job, whether that is income from a side gig, freelance contract, trade, or business. Basically, the government wants people to start businesses, create jobs, spur innovation, and grow the economy. So to foster this, they give tax breaks to people who do these things to incentivize more of this behavior. Now, the most significant tax break is Section 162 of the tax code, which allows you to write off all ordinary and necessary expenses in carrying on any trade or business. So in any trade or business that you pursue, the government will allow you to write off any expense you incur that meets this simple criteria. This may include writing off portions of your home expenses, car expenses, travel expenses, meals, health insurance, and many other expenses that you already pay for. If your business uses any portion of it, you can likely write it off. But not only do you get more write-offs, this provision also allows you to create write-offs to reduce your income and taxes as well. We see people use this to buy cars, hire a family member, spend more money on advertising, and more to create tax write-offs to reduce their taxes even more. When you are classified as a business owner, you are literally in the driver's seat of your tax strategy and the amount of taxes you actually end up paying. There are over 100 tax deductions that you can use to avoid paying taxes. Lever number 3, optimizing your investments for lower tax rates. So when you invest directly into assets like stocks, bonds, and real estate, there are several other ways to avoid paying taxes. The first way is to simply hold your assets and not sell them. You only pay tax on assets when you sell them, not when they appreciate in value. So if you never sell your assets, you will never pay taxes on it. In fact, some people borrow against their assets in their portfolio instead of selling them to get money from their investments without paying taxes. This is called the buy, borrow, die strategy. Basically, you can take a line of credit against your investment portfolio. And of course, if you do this, you will pay interest on the loan, but the amount of interest you pay may be much less than the taxes you would pay if you sold all of your investments. Plus, if you don't sell, ideally your investments would continue to grow in value, which could also justify taking on the interest expense. Now, the next way to avoid taxes is to simply choose the best timing for selling your investments. If you must sell, then you should aim to sell at a time where you are in the lowest possible tax rate. And there are a couple ways you can accomplish this. First, you can do this by selling your investments as a long-term capital gain. To qualify, all you have to do is hold your investments for at least 12 months before selling it. And when you do, it qualifies for a lower capital gains tax rate, typically ranging from 0, and yes, I mean 0, to 20%, depending on your overall income and filing status. If you do not do this, then your gains will be taxed at ordinary income tax rates, which could be as high as 37%. But not only do you want the lowest type of capital gains tax, you can also optimize for the lowest amount of these taxes. Some people are able to time the sale of their investments when their capital gains tax is 0%. For example, if your total income is under $47,000 as a single taxpayer or $94,000 as a married taxpayer, your capital gains will be taxed at 0%. Or if you have a 20% tax rate, selling in a year where it is 15% may be more beneficial. The bottom line is that you can control your tax rate by carefully planning the timing of when you sell your investments if you decide to do so. Drop a comment below and let me know your favorite ways to avoid paying taxes. And if you want a plan that is guaranteed to reduce your own taxes, just apply to work with one of my CPAs today at mycpacoach.com.